Let's talk about theft of cash. Okay, the first scenario is what we call larceny, and that's as opposed to skimming the cash. So larceny means the cash is on the books. It's come in, the debit has been performed, so that cash is on the books. It's a little easier to catch than skimming because, right, we know that cash is there. It's got to be accounted for. In order to be able to steal it, you're going to have to arrange for a credit to take place to cash and something that will explain why that cash is missing. So, it can be something as simple as you just say your drawer is short, right? You've rang up the sale, but then you took some of the cash and put it in there because the person's going to want a receipt, right? But, when you're doing that, you can just say, well, every once in a while you're going to be short. I guess the response is every once in a while they should be over. If they're only always short, then that's probably something wrong. It happens. So what we call larceny is when the money's on the books and then they take it, right? So it's been rung up in the cash register, it's been posted to the account receivable, something like that, and it's already on the books, and that's called larceny. There might also be skimming. Okay, so skimming is stolen before it gets recorded, right? So, in other words, they're working at the sales point of sale, the drive-through, the cash register, and instead of ringing it up on that cash register, they just accept the money and maybe make some change and give it to the customer, but the money goes in their pocket. It never even got issued as a sale. It can also be things like when a payment is made for an account receivable, they don't post it to the receivable, they keep it for themselves. They have to cover this stuff up, of course. So they have to do something then, like if they stole it from a receivable, they'll need to write off the receivable so the customer doesn't keep getting a bill. They'll need to do what's called lapping. Take the next customer's money and put it on that, right? And they have to just kind of keep up with it. But that's what we call skimming, where they take the money before it even gets into the books. And of course, fraudulent disbursements. When we're talking about the big dollar asset misappropriation of cash, that's this. That's your fake purchase orders. That's your billing schemes, right? That's payroll disbursement. That's how people get away with the big dollars. Yeah, at the drive-through you could charge somebody $2.50 and then put it in your pocket. You're not gonna make tons of money skimming at most places where you could do that, where people aren't gonna ask for a receipt. It's like, no, you don't ask for a receipt at the coffee shop, so you could probably get away with it. But how much can you really get away with? The fraudulent disbursements, that's where the large cash theft occurs. Fraudulent disbursements. And so there's basically 6 ways that have been identified that someone can get money out of an organization. They can commit this organizational fraud. And one is a billing scheme, check tampering, expense reimbursement fraud, payroll disbursement fraud, wire transfer schemes, and register disbursement schemes. The case that we're going to do for Chapter 14 is a register disbursement scheme. And here you go. You've got your list of all of them. And it just kind of defines a billing scheme as when they send a kind of a fake bill to the employee and keep the money for themselves. Check tampering, they get a check that's legitimately issued and they steal a blank one, or they get a legit issued one and somehow intercept it. Expenses, so you just say you have more expenses and you keep the money for yourself. Payroll fraud, either have a fake employee, a real employee quits but they don't tell anybody they quit. A person commits payroll fraud when they say they worked 10 hours and so they could get 2 hours of overtime for that day. They only worked 8. Wire transfers, moving money out through wire transfer to a personal bank account, and of course cash register disbursements. So you can, if you've ever returned something and they gave you the money back, well, that would have been coming out of the cash register, and so sometimes people do fake voids or fake returns and take the money out. They void a sale that's occurred and take the money back out. All right, so let's talk about these. First is check tampering, just real quick. If an employee has the authority to prepare checks, they'll just prepare one for themselves somehow, or something that they can cash. Or there is a check that is written, it's a legit check, and that employee intercepts it and then somehow cashes it. They double endorse it or something, change the payee, something like that. Check tampering. Tamper with a check, just like it sounds. Registered disbursement schemes tend to fall in two categories, either a false refund or a false void. So again, money has come in, it's in that cash register. So how can you get it out? Well, you could say, oh, I did a refund today. I gave this customer back money, they returned something, and I gave them the refund. So that's one. Of course, there's not one, it's false, but they keep the money. Or a false void. So when you ring up a sale, it rings up, and then they say, oops, no, never mind, that wasn't the price I thought it was, take it off, I don't want that. And so that happens. You probably have seen things like, you've probably done something like this at HEB, like, oh, never mind, I don't want to buy that now. And they have to have the manager come over and do the override. That's because they're trying to avoid these false refunds and false voids. Right, that's why you have to, when you return something to, say, Lowe's, they make you sign and show your ID and do it, because they're avoiding the false refunds. If they have to know there's an actual person getting the refund. So that's what that's about. It's not that they don't trust you on the refund, it's that they don't trust the employees not to do these false refunds. Of course, billing scheme. Several ways to do this. I think in past cases we've talked about setting up dummy companies, shell companies, where you just make up a company and send in an invoice and get paid by the employer. If you're the person who authorizes those kind of things, you just make up your own company and authorize it to that company. You can double pay an invoice, right? Say a legit vendor that you're working with, colluding with, and you pay them twice and they give you some. Or just make a personal purchase with the company funds. Order something. If you're the purchasing agent, order something, have it sent to you. Something you want. Expense schemes. So companies do reimburse expenses. Even this university reimburses expenses when I buy something for the lab, or when I go to a conference, they'll reimburse some things sometimes. So people submit those expenses to the accounting and they pay them. They give them cash money. They send them a check, put it in their bank account, something like that. So an expense scheme would involve saying something, they spent some money when they didn't, saying this was a legitimate expense when it wasn't, overstating, same expense multiple times. So when you get expenses reimbursed, they make you show receipts and do things. So it's sometimes possible to lie about these things. And that's an expense scheme. Payroll disbursement. So getting a payroll check cut requires usually some proof that a person has worked. So they have, time systems, keeping track of people's times. And for salespeople, they keep track of their sales. So any of these things can be manipulated. A ghost employee is when there's a person who's not actually working on the payroll. A lot of times this happens when somebody quits, the manager won't take them off the payroll and just keep getting that employee's paycheck and keep it for themselves. Sometimes they add fake employees. Of course, all kinds of employees could falsify their hours and get extra pay. It can be hard to do nowadays. They have so many biometrics. You have to show your thumbprint or your retina, or at least scan something so that they know you're physically there. It's a little harder to falsify hours, falsify commissions, fake sales, right? If you can approve a sale and get a commission on it, you could make sales that are fake and make a fake account receivable and then get a commission and then write off the receivable, something like that. And of course, false workers' compensation, you know, saying you're hurt when you're not. Even the executives do it. Your book has a couple of examples if you want to look at it. Of course, when the executives do it, the dollars are a lot higher. So that's all the different cash disbursement. I mean, not cash disbursement, but different cash misappropriation. On our next video for this chapter, we are going to talk about other kinds of misuse of assets and other assets that people steal.